Welcome everybody. Derek DiManno, founding financial advisor, Flagship Asset Services. And this morning, if it is morning where you are, you're joining us for the Clarity Cast, where we have collaborative conversations with other industry professionals, product specialists, knowledgeable individuals in their field. And today I'm joined first and foremost by a friend, but also a longtime business partner, Brian Villec. Brian, so good to have you, man. Why don't you introduce yourself?
Yeah, great to be here, Derek. Thanks for having me. My name is Brian Villec, and I'm a certified financial planner and insurance consultant for advisors, as well as a financial advisor myself on a referral basis through many of my insurance partners. And yeah, I've got an expertise in long-term care insurance, and I'm a certified financial planner. Derek and I have known each other for, probably close to 17 years now. And coming up on my 30th year in the business, it's hard to believe that time's flown that fast, rather. And yeah, I'm looking forward to talking to you.
Yeah, it's great, Brian. Yeah, so that good memory, Brian. It's easier for me because I can mark our relationship and our friendship by my wedding because you were there, and so that makes it a little bit easier. Although I don't have it down to the day. So great to have you on. And today we were going to talk about insurance, like really big topic there, of course. And what we had decided is that we were going to narrow that down into a specific type of insurance and in planning around that. And we're going to talk about some long-term care insurance and the periphery that goes around those types of policies and the planning. So maybe Brian, if you'd like, kick us off with some thoughts. It's really, I think a lot of people that are listening to this will come maybe with some thoughts already on care and long-term care and the insurance product that goes along with it. So this can be somewhat of a hot topic. So maybe just get us going.
Yeah. Well, Derek, you and I have been in a book club since COVID. And one of the things that I was thinking about when I was preparing for our conversation today is a book by Annie Duke, Thinking in Bets. And I think a lot of times, myself included, you don't do something and you don't have a negative outcome. So you look at it and say, okay, well, I made the right decision. And Annie talks about the concept that in poker, sometimes you get a favorable outcome even when the odds are stacked against your favor. And it's important to understand that just because you didn't get a negative outcome doesn't mean that you made the right decision in a situation. And I think that with long-term care insurance planning and long-term care planning in general, not doing the planning, even if you have a favorable outcome and live a long and healthy life and never have an event, doesn't mean that you made the right decision. Regardless of whether you purchase insurance, the planning is so important. To have an understanding of what you would do if, how you would handle it, and what resources that you have available to cover it. That planning at a base level, everybody should do. Whether or not they end up purchasing the insurance product, is a separate decision.
Yeah, Brian, I think that let me start with that. That book is great, right? Annie Duke, good book for anyone that's interested in reading something that maybe is a little bit different in the way she thinks, given her background through success in poker. But that whole idea that we measure decisions based on the outcomes, right? And sometimes we make what is maybe seems to be the best decision and don't get the outcome we want. We get like a negative outcome. So kind of the opposite of your example. But the thread that you're pulling at, I love so much is that like those conversations have to be had. And the other piece of that is I feel like um, I'm going to say everyone, generally most people have been sold something in their life. And that may be an insurance product, that may be an investment product. Man, it may be like an expensive suit or a car, but everybody knows that feeling of they are interested in something, but then they feel like it was sold to them rather than they made a purchasing decision. And
Sure.
so I mean, I think what you were sharing hints around that whole idea that when you're talking about something like morbidity, right, and chronic illness, and these are like sensitive topics, right? They're not normally the ones that you bring up lightly over, like your mashed potatoes at dinner. They take a little bit of care and tenderness, right, when you're talking about them. Like the first thing it seems like is that we just have the conversation, right? That we start bringing that out into the light to say, okay, so what do we really have here? And so I mean, I love that. So from a high level, we need to have the conversations, maybe just a little more pointed. Like, so what are we having a conversation about? Like, so what is long-term care, and what is this thing long-term care insurance? Let's maybe kind of set the table with that.
Sure. Well, long-term care is an event where you need custodial care. It doesn't necessarily have to be later in life, but we tend to think about custodial care as being something that happens to us when we're old and frail. But it could be a traumatic injury that occurs due to an accident. It could be a debilitating disease or chronic condition that creates it earlier in life, like early onset dementia. And that need for custodial care comes at a cost, and insurance helps protect against the financial consequences of that long-term care event. The triggering event for long-term care is things like you mentioned earlier, Derek, that we really don't want to talk about, like the activities of daily living. The idea of thinking about a time in your future where you might not be able to perform the activities of daily living is uncomfortable. And some of the activities are ones that we really don't want to talk about in polite conversation, like toileting or continence.
Sure.
Often when I'm talking with a client about insurance, I don't even mention those activities. I say there are 6 activities of daily living. And if you can't perform 2 of those 6 activities, that would be a triggering event for long-term care insurance, assuming that the need for custodial care is expected to last more than 90 days. And then what I usually do is focus on 2 that people probably could consider needing assistance with later in life, like transferring, getting up and down the stairs. Maybe you get to a point when you're in your 90s or late 80s where you can't physically get up and down the stairs to get in and out of bed without somebody helping you. That would be one of the activities of daily living. The other might be bathing. Now, it might not be necessarily that you can't physically wash your body, but the act of getting in and out of the bathtub, is a slip and fall hazard for you, and you need somebody there to provide substantial assistance to stabilize you and keep you safe from injury while you're bathing. So I usually use those as the 2, but those are only 2 of the 6, right? The others are, I mentioned continence and toileting, eating, dressing are the others. Now, there's a separate way for somebody to potentially be eligible for a claim on a long-term care insurance policy, and that's a cognitive impairment. So if you have Alzheimer's disease or dementia later in life, you may be able to perform all of the activities of daily living, but because of that cognitive impairment, you need supervision and you need assistance, and that would be its own triggering event. Again, it needs to last, expected to be lasting more than 90 days, and that would trigger a benefit on a policy.
So Brian, maybe just to because that's a lot of stuff, right? So the first thing is, so long-term care, or like a long-term care event, is an event where an individual no longer can do activities of daily living. So they're considered chronically ill and they're not going to get better, right? They're not going to recover from that, right? And so
Not,
activities,
not actually, not necessarily, Derek.
okay.
A long-term care event doesn't have to be a permanent event.
Hmm.
So there are situations where somebody might qualify for long-term care benefits on an insurance policy, need custodial care,
Hmm.
but they may get better. Like for instance, if I were to slip and fall and break my hip, and it was a severe break, and I needed rehabilitative care and custodial care for 6 to 9 months while I was convalescing and rehabilitating, but I eventually get better. I could go in benefit or on benefit for a long-term care insurance policy, and then come off benefit when I get better. But most of us probably think about long-term care as being something that's more permanent, but in many cases it's not.
Got it. Okay. So, I mean, I think so. All right. So thanks for sharing that. So, when we talk about the most common fact set, we're talking about someone that becomes chronically ill, right? Or that chronic illness is through a wearing down of parts and so forth, like you described, right? With an expectation on an insurance policy, which may have a waiting period, that it's going to go through that waiting period, right? And then continue for some time. And in your example, where someone's getting better, if there was a 90-day waiting period, the expectation is then after that 90 days, there's still months of care that's need to be given. And so technically they can go, into benefit. So
Right.
couple of things that I wanted to pull out. And we could get really down in the weeds, but I think at a high level, we're having conversations. I feel strongly that you're going to agree with what I'm going to say is you're having these types of conversations, not just with your family and potential caregivers, but also with a trusted professional, that you feel is going to make, guide you in a fiduciary capacity through this process, right? And then there were a couple of words in there that I think, so you mentioned custodial care, right? And you mentioned activities of daily living. So the activities of daily living, I think, is pretty simple because you outlined there's 6 things. Some of them are easier to imagine ourselves not being able to do, like dressing ourselves or bathing ourselves. And then some of them are like less pleasant to think about not being able to do on our own. Then you mentioned, or also you mentioned this idea of custodial care. So maybe just let's take kind of like the technical term away and maybe just talk about what you mean. What does that look like? So if I'm listening to this now and I have an aging parent, or myself, if I feel like, man, like at some point this they could be describing me, like what does that mean?
Sure. Well, I think there is a lot of confusion around it, certainly. And clients will probably occasionally come into your office, and I know they come into my office thinking that they have coverage for custodial care needs through Medicare, because Medicare offers a skilled rehabilitative care benefit associated with the program. But there are a lot of stipulations involved in that, and that skilled rehabilitative care is not custodial care. So custodial care is literally for those activities of daily living. It's not to help you get better. It's not the physical therapist helping you with exercises and helping you get back the range of motion or the ability to eat and drink after a stroke, or whatever it might be that requires skilled care. It's that custodial care, the stuff that we all need to do, but doing those things and getting assistance with those things is not going to get us better. And that would be eating, dressing, bathing, continence, transferring. Those things are not going to get us better. Now, we might be receiving skilled rehabilitative care at the same time, that we're receiving custodial care. But ultimately, Medicare is not going to cover that custodial care, and Medicare has a limited benefit, maximum of 100 days on the Medicare, assuming that you qualify through the events. And that's kind of outside of the scope of our conversation, certainly.
Sure.
But
Yeah.
the custodial care is really for the non-rehabilitative work that needs to be
Yeah.
done.
So I mean, there are a couple of things there, right, Brian? Like one is you start having this conversation, and all of a sudden there's this other piece, which is, okay, so Medicare, and you didn't say the word, but then Medicaid, and these, like, all these things. This is like melted Neapolitan ice cream, right? They all start to blend together. But where are the actual lines? So let's not go down that. We could have a whole separate conversation. Maybe we will get some comments, and maybe we'll do that on Medicare, Medicaid, and how that all fits in. But so those are considerations duly noted, right? Something you mentioned in the description of custodial care that stuck out to me that I think is important is that in your description you were talking about the type of care being given, but not the location. Right. So I think that let's talk a little bit about where you might receive custodial care. And then if we could, why don't we talk a little bit about how a policy might handle that if you actually had an insurance policy to help pay for some of these things.
Sure. Yeah, well, most people want to stay at home, certainly. And policies that are sold today, long-term care insurance policies offered today, offer both home health care benefits as well as benefits in an institution like an assisted living facility or a nursing home. So you have a broad range of areas where you can receive coverage and care. Again, most people want to receive their care at home. At some point, it may not be practical for them to continue to receive care at home. And at that point, they may need to go into a nursing home or an assisted living facility where they can receive 24/7 care. But I would say that most claims for a insurance policy start at home because most people, are starting their care continuum at home. Now, occasionally, certainly, the care need starts because of an acute situation that requires that they immediately go into a facility, maybe a significant stroke or some other, event like that, where you go from being healthy to, not being able to perform the activities of daily living all at once. But it's usually a gradual decline, and it starts with, friends and family, doing the grocery shopping for you or becoming your Instacart, as I had a friend mention last night when he was talking about his parents.
Yeah.
And then it kind of develops from there to a point where it's not assistance with the incidental activities of daily living, balancing your checkbook, doing the grocery shopping, et cetera. It's the more important, daily activities that need to be you need help with. And it maybe could be family members coming in at night to do that. And then eventually the heavy lifting becomes so challenging for the family that they need to bring in a nurse. And that's where, when we get to that point, where an insurance product could potentially step in and start, providing the care.
Right.
I think that a lot of times family wants to take on more of the work than they're physically capable of and equipped to handle. And I always encourage the family to be care managers and care advocates, not necessarily daily caregivers. And to protect their own health, because it is physically demanding work to help people get in and out of the bathtub or up and down the stairs or in and out of bed.
Yeah, Brian, I think that's a really great point. And so, like, when you're thinking about, like, we want care at home, and maybe it starts with your helping mom and dad, or Uncle Tom or Aunt Susan or whatever that looks like, right? And then it gets to the point where, like, this isn't just driving them to the doctors and doing this. This is like, and it's upping, and then we need some assistance, some sort of, I'm going to use the word skilled. And for anybody watching this, like, there's all sorts of like loaded words that like are technically insurance words but the idea is that we have an outside person that is providing help, let's say, and then that progresses generally to the point that like the home is no longer a suitable place and we make this transition. And so there's all sorts of things like when we talk about the policy, like how the policy pays and and to your point, you just said I would encourage a family to think about like being the manager. And so like if there's a policy, there's that, what does that claims process look like? So I mean, again, this is similar, I think, to that Medicare Medicaid conversation. We could have a whole conversation about the evolution of these products and how they deliver like the benefit and what that looks like. And Brian, I'd like to stay away from that and maybe talk about something I think that would be more useful for our listeners, which is, okay, well, how do we figure out like where do we even start with how much we might need? Like, I mean, this is like, so if we've started to think, yeah, maybe this is something we should consider. And maybe that now we've had this conversation, we're thinking, well, maybe we don't want to self-insure for it. Like we're not like, we want to start to investigate moving some of that risk to an insurance company in some sort of way through some sort of product, right? Like, how do we even get started with figuring out like, what does this look like? Knowing that we could ask a friend or a neighbor, but not be certain that we're getting like accurate information. Like, can you speak to that maybe a little bit? I mean, I have some thoughts, but I'm interested in maybe like where you might suggest somebody gets started.
Yeah, it's kind of funny because you mentioned the topic of self-insuring, and it's kind of like nails on the chalkboard. I taught a course at the University of Delaware on insurance for a while for their financial planning degree program. And you're not really self-insuring, you're just choosing not to transfer the risk. You're retaining that risk, but you're not purchasing insurance because you're going to have to use your resources to cover any claims that might come due if you have no insurance. I think the key is if we're going to retain the risk, do we have separate resources set aside to cover it? And I think that's the biggest mistake that a lot of people make when it comes to the idea of, retaining that risk and covering those expenses if they occur, through the assets they've accumulated and saved and worked hard to save, during their working lives. Mm-hmm. And the reality is most importantly for this is if you need those resources to provide income in retirement, mm-hmm. you can't count those resources as resources that are available for long-term care. That's the first thing. If you're going to retain that risk and not transfer it to an insurance company, and you need to draw $50,000 or $70,000 off of your investment portfolio, you need to think really long and hard about what would happen if I now had to draw $200,000 off of my portfolio every year because I need that $50,000 to $70,000 for my healthy spouse's living expenses. Because they're not going to get cut in half magically because you don't need, to be out there doing, fun things in life, but your spouse is going to continue to need to be out and engaged and mm-hmm. socialize, and there'll be expenses associated with that. And when you take into account and stress test your portfolio, including the cost of a long-term care event, mm-hmm. I think that many people find that, the insurance provides them a potential better outcome for their family and protecting that healthy spouse than retaining that risk. Now, for some individuals, they have excess money set aside for retirement that they don't need for income. And it's a matter of using those excess resources for their long-term care needs. And in that case, maybe, retaining the risk, is not necessarily a bad thing. But ultimately, that's my biggest concern is when somebody is double counting resources and expecting that, they can handle it.
Yeah. That's great, Brian. So it's not that was a loaded question, but I asked that question and that was a great answer about, retaining risk and are we really planning or are we just ignoring it? Like, I love that. And it's different than I guess where I was where I was thinking. And so which is so perfect, because I think everything you said is spot on. And all of this stuff that we're talking about points to having the right conversations with trusted people, asking questions that not necessarily are like the right questions, but continuing to ask questions to make sure that we've thought through all of this, right? And then in the beginning, you said we were talking about Annie Duke and, like basing decisions on outcome, right? And I think to say that a different way, and actually to hearken to another reading that you and I have done, the idea of saying, okay, so like, what's the direction? What's the goal? And then are the decisions that we're making in our planning, are they aligned with that direction? Well, I know that sounds so simple, but a lot of times I don't know that very basic question is asked. Like, sometimes making a decision feels good now, but is moving you away from the long-term direction. And so in long-term care planning, just like so many things, I think that's important. One of the things that I was thinking that would be helpful for anybody that might be watching this and thinking, man, this is really applicable in some way to me or a family member or a friend, is like, how do you get an idea of what these things might cost? And I don't mean the insurance product, I mean the care. And so there are some resources out online, and the way I like to think about it, and all this stuff has moved. And so after when this gets posted, I'll make sure that we share the link that will give some of this research that's collected and is totally available. But looking at what you just said is, okay, well, we're going to transfer risk to an insurance company. Like, what portion of that gets transferred? And it wasn't that long ago, pre-COVID, that it just lined up in our area very well, where you could say, okay, well, you had like home care, then you had assisted living, and you had a nursing home, and the cost of assisted living was almost perfectly half of a nursing home. And so if we planned that we were going to transfer the risk of assisted living to like an insurance company through a product, we knew that if we ended up in a nursing home, that we've covered half of that cost, right? And so the numbers have kind of moved around, and they're different in different areas. But I think thinking about the planning, and this is probably the real thing that I want to articulate, is that it's not a zero-sum game, right? Is that and when I first started in this industry, I thought about, well, to do this right, you need to insure for the entire risk. But I think the truth is that even a very modest benefit can be of help to a son or a daughter or a niece or a nephew or a spouse that's getting really tired trying to give care on their own and avoid spending down assets,
Sure. Yeah, well, full-blown nursing care is quite expensive. Yeah, and like you mentioned, it is geography dependent. The cost of long-term care, nursing care in Western Maryland is going to be different than what it is in Baltimore, Maryland, or Baltimore, Maryland is going to be different than New York City. Yeah, and that certainly plays into it. And ultimately, somebody might choose to move closer to one family member over another in order to leverage, different cost structures in nursing care. But like I mentioned before, usually people don't start in a nursing home day one. They're starting at home. And many people never progress from that. They're able to maintain the remainder of their life with just custodial care at home and having a licensed healthcare professional come out and assist them with the activities of daily living. And that might not be 24/7. Certainly, if it were 24/7 that they needed care, they'd be better off in a nursing home from a cost perspective. It'd be a lot less expensive than hiring somebody at an hourly rate to be in your home 24 hours a day, 7 days a week.
Mm-hmm.
But if you only need care maybe 3 or 4 hours a day, maybe somebody to help you bathe in the morning, to get you from bed to couch, to help you administer the medications that you have to take, maybe to cook you breakfast and lunch, and then they can kind of set you up to have a family member come in and check on you later in the day. You might be able to maintain that structure for the rest of your life and stay at home with custodial care, on a part-time basis through nurses and other gaps being filled by family members. That might cost $7,000 to $10,000 today. We don't necessarily have to transfer all that risk to an insurance company. If we were going into a nursing home, it might cost more like $15,000 to $17,000 to, depending on the quality of the home that you're going to, and whether you have a private room or you share a room with somebody for the first time since you were in college, right? Other than your spouse. For that reason, for all those reasons, people certainly want to stay at home as long as they can, and many can. But ultimately, having a policy is better than having no coverage at all. I'm actually working with a client right now, and they were adamant that they wanted me to show them, the cost of a fully funded nursing stay on one of the hybrid lifelong term care products, and I think that. I'm having difficulty connecting with them for our follow-up conversation because the premium that they saw on that policy is probably a lot more than they expected.
Yeah.
I find that most people end up purchasing a policy with a benefit between $500 and $7,500 a month, possibly depending on their age. The younger they are, the more likely this is going to be the case with some sort of inflation adjustment on it. And that would cover maybe 40 to 60% of the cost that they would incur. And it would ease, and slow down the spend, on their investment portfolio to cover the care. And it would protect that healthy spouse in a way that would allow for them still to have flexibility for the rest of their life to be able to use the investment resources to maintain their retirement lifestyle.
Brian, so that last piece that you just said, I think, to bring this kind of, as we get close to time here, to bring this kind of back around to planning, the context of a holistic planning, and the idea that your heat doesn't go out on the warmest day of the year, it goes out on the coldest. And so doing proper maintenance on your boiler or your furnace is imperative before you have, -7 degrees. With or without wind chill. Okay. So I think a couple of things is having an honest conversation about what care might look like, right? Who would be potential caregivers, and realistically, what would we be able to expect from them, or what are we comfortable expecting from? Because those could be two different things. And then regarding the resources, and then what are those resources, and are we tricking ourselves into self-insuring, which is really just saying, okay, well, we're going to ignore the fact that costs could dramatically go up, and that spend down could be, mom and dad or Uncle Tom had a lot of money and then he had no money because this was a missing piece in the planning. And then one step even beyond the idea of this whole planning, do we have a policy, who's going to have it, having these questions, talking about these things, is that even if you have plenty of resources to pay for the long-term care, I think having these conversations is important, because the potential use of an insurance product as a hedge, it is now a lifestyle planning tool, and maybe it's a tax planning tool to create an income tax-free insurance benefit that prevents a spend of a taxable asset. So that's really kind of more complex stuff. But what I would encourage somebody listening to this is just to say, okay, well, let's start the conversation, and then let's bring the right people into the conversation so that we can start turning these stones. And in your example, you mentioned like a request for this really large benefit, which came with a really large premium. I think what I would say is, as you tiptoe into this, is to be open-minded to the idea that we are like optimal may not be best, right? So the very best, like, you know, and I don't even know, you know, I don't know if a Rolls Royce is the best car, but for most people commuting to work, that's probably not the optimal car, right?
Yes.
And so I think when you look at these types of things is just to make sure that we don't, you know, start to build these mousetraps in our own mind of where this thing should go, and we really do the planning, you know. With
Yeah,
that, go ahead,
Derek,
Brian.
I think you know, ultimately what ends up happening is that we all approach it a little differently. Like in our mind, we all have a slightly different perspective on what long-term care insurance and whether it's important to us or not.
Mm-hmm.
And some of those perceptions are maybe misperceptions. We talked about some of those in terms of, you know, I have the money to, retain that risk versus transfer it to the insurance company. But I think that one of the misperceptions that I run into is that, well, all I'm doing is protecting resources for my kids or grandkids. Now,
Mm.
for some of my clients, that would be enough for them to buy the policy, right? For
Sure.
other people, they're like, well, in the unlikely event that I have a long-term care event and there's nothing for my kids to inherit, then so be it. I would like for them to inherit something, but if I needed it for long-term care, then that's fine. But at its core, I'm not necessarily as concerned about the kids, unless my client is. I'm concerned first and foremost for the healthy spouse,
Mm.
making sure that the healthy spouse retains their dignity and quality of life, throughout this process, and that they don't feel that they have to take on more of the heavy lifting than they are equipped to physically. And I see it, I've seen it in my own life with neighbors where we didn't realize how difficult a time one of our neighbors was having until her husband passed away.
Mm-hmm.
Her husband slowly declined over 10 years because he was providing the bulk of her care and not sharing that responsibility with anybody else. Ultimately, I believe it cost him his life earlier than he would have otherwise died, because he took on too much of that heavy lifting. And the family told me that they could see all kinds of things that he did in the house that they didn't necessarily immediately notice, to help lift her and move her and get her up and down the stairs. And everybody was, most of them didn't realize that, mom needed, as much care as she did until dad had passed away. And then mom ultimately went into a nursing home, and received care there and lived for another 7 years. But I think that she would have had her husband around a little bit longer if they had used some of the resources they had available to cover the care that she needed, or or ask for help from family and friends. And I think that that's a valuable place for insurance to come in, is because many of my older clients, and I'm sure many of your older clients as well, have saved so hard for so long that they have a tough time spending money.
Mm-hmm.
The idea of having to pay out of pocket for, a custodial care nurse to come into the house at the cost of maybe $4,000 or $5,000 or $6,000 a month is enough for them to take on more of the heavy lifting than they really are capable of doing. An insurance policy would give them permission to bring that person in if they can. But I'm going to say one final point on this is, that whether we buy the insurance product or not, the plan is the most important part. Having, the conversations that we've talked about with family about what care will look like. No plan for retirement is complete without a plan for long-term care. And that doesn't necessarily mean that we're buying insurance, but it does mean that we're having the conversations, that we're understanding what it'll look like, who's providing the care, how we're going to pay for it if we need it. Because if we don't, what we end up getting into is people end up taking on too much physical responsibility for that than they can handle.
Yeah, Brian, I love that. I mean, so maybe in closing, it really comes down to starting the conversation and doing the planning without already having the idea of what the outcome is going to be, but knowing what the long-term goals are. And so it's 2 out of 3 people are gonna need some sort of care, right? And so even if you're listening to this and you're thinking, well, I'm the one that's not, I would encourage you to still have the conversation. To your point, that it's really not about whether a product is purchased or not. It's about, have we done the proper planning so that all the other stuff that we've done up to this point to be successful, doesn't come apart, right? We don't end up without heat on the coldest day of the year because we didn't do the planning when the weather was good. Yeah. And so it's been really enjoyable being with you, Brian. I appreciate your insights, and hopefully we can do this again sometime soon.
Yeah. Thanks, Derek.